So I thought I'd start off with just a quick top-down view on markets. So we feel, or certainly I feel, that markets this year are going to be vastly different to last year, and you're already starting to see that. I mean, volatility is back. You had 13 up months, minimal volatility at historically low levels. Vol is back. That's point one. Point two, we think inflation is rearing its head. If you listen to all the company earnings calls in the last quarter, they are screaming inflation, just screaming inflation. You look at interest rates. Interest rates are moving higher. We don't know what the velocity of that move is going to be, but they're moving higher. And this is all in the US. I'm focusing on the US. The US is the driver of the bus typically. So rates moving higher. The other dynamic there is the labour market is extremely tight, and that has an impact. So these are variables that 12 months ago as an investor, we didn't need to focus on. But today, if you're not focusing on them, you've got a problem. That they will impact the investments you make and the companies that should be in your portfolio. So what is our portfolio? Again, I just want to reiterate, we focus on mid-small cap global companies. Companies with sub $10 billion market cap, that is where historically we've made our greatest returns. It is 8 times larger than the mega large cap universe. So just taking you down to the portfolio. So in that environment, what we've done is we've gone through our portfolio and really stress tested it. We believe the market could bifurcate this year. So companies that have been reliant on cheap capital over the last 10 years, that's just not going to be around anymore. So if you've got dodgy free cash flow, negative free cash flow, if your returns have been relying on accessing really cheap capital, not going to be available. If you have got a huge part of your costs is people, wages are going up. Minimum wage in a lot of companies have gone from $9 to $11. That's over 20% increase. These things, these dynamics that weren't there 12 months ago are going to affect profitability of companies. So we're very mindful of that, and we keep blocking and tackling, adjusting the portfolio to make sure we don't get caught up in that scenario. So if I look at all the companies we own, what we're looking to do is own companies that have tailwinds, and in many instances, irrespective of the market. So I'll give you one example. If you look at Zayo, so fiber is to data traffic what a road is to a car. Like, you need it. And the growth in traffic data traffic in the last 10 years has been phenomenal, 12x. In the next 10 years, a big driver of that is going to be 5G that comes in a couple of years' time. Why is that going to drive data traffic? Because the speed with which you can download data will increase tenfold. You'll be able to download a HD movie in 2 minutes instead of an hour. Massive difference, huge driver of data traffic. So how do you get exposure to that? Fiber. All the traffic has to go on fiber. In the US, the only way to get exposure to a national, dense fiber network as a pure play is Zayo. The industry has consolidated dramatically. These guys have really started to crank up their performance operationally, in that they're in the buildings. Now they're selling into the other tenants in the buildings, which is very high margin, low hanging fruit business. Phenomenal upside from an operational standpoint, and from a valuation standpoint, deals for regional fiber assets have been done at a 30 to 50% premium to the current valuation of this company. And if you think about that, no matter what happens in the economy, people are not going to say we're going to consume less data. That's how we like to think about things. We want tailwinds. And if you look across the group, we own one of the largest independent content providers in the world. There's huge tailwinds behind content. We own the largest online gaming company in the world, 70% share of poker, 10 times its largest competitor. If you look at the US market, that is likely to open up, deregulate. That could more than double the size of this business. Tailwinds. Just can't reiterate enough. This portfolio has serious tailwinds behind it. So I just want to have a look here. If you look at the market capitalisation across the portfolio, only 16% of the portfolio is above $10 billion. Why does that matter? If you think about domestic portfolios, most portfolios would have exposure to large, mid, small and micro. Why would a global portfolio be different? There's huge exposure, concentration towards that large mega cap space. If you have a look on February 5th when the market tanked, that huge, fell dramatically over a half-hour period, what's really interesting, Dow was down 4.2%. Some of the big, heavily owned names that have massive ETF holdings, Amazon, J&J, McDonald's, were down 8% over the same period of time. The small cap index, down 1.6%. Really interesting to note. And then you can see our exposure here is Europe, US, UK centric. We're a portfolio of highly concentrated portfolio, 20 to 40 stocks, typical position size somewhere between 2 and 8%. We hedge the currency. We're sector and country agnostic. We can have a high cash position. And then I thought I'd touch on performance. What's really interesting here is the portfolio has performed consistently over almost 3.5 years since it's listed. It's been significantly less volatile than the market. The team that runs this portfolio is steeped in family office background. It's about protecting capital in tough times and about making strong risk-adjusted returns when the market's performing and making sure that we pick the right stocks that will perform well when it's not performing. And you can see here materially less volatility. If you look in February, the portfolio performance was relatively quite strong. So over that longer period of time, you can see performance has been very, very solid. The other thing that's worth noting is the dividend. 3 cents, fully franked, sustainable. We have a dividend reserve that makes it sustainable. It's not a dividend for dividend's sake. And then I think the last thing that's worth touching on is options. And I suspect there are a number of you here whose clients would have options in EGI. They stop trading on the 3rd of April. They expire on the 10th of April. They have a strike of $1, and the current fully diluted NTA, assuming all options are taken up, is $1.18. So there's significant material upside in exercising the options.